thank you. The Fed is likely to lower interest rates soon. What money moves should you make before the interest rates change? Our friend Chase Wilsey is here to explain. Chase, good morning.
Good morning.
Okay, what are we supposed to do with a change like this? Let me get my pen out and my glass, because this is very serious. It's money.
Of course. Well, you know, I want to say that the first rate cut is likely going to occur this month.
Okay.
It's only going to be what we say is 25 basis points, or 0.25%. So right now we're like at 5.25. It'll come down to around 5. So it's not a major shift in the current interest rate. And also, too, what we should see is continued cuts going forward over the next year or 2 years. We should see that rate come down further. But come September, there's not going to be a major shift in interest rates.
Okay, so what does that mean for the person who's watching right now?
Yeah, the thing I always tell people is you have to understand the difference between what I call the short end of the yield curve and the long end of the yield curve. And kind of simplistically put it, you have like 2-year treasury rates and you have 10-year treasury rates. What happens is as the Fed starts to cut interest rates, that short end of the yield curve, which is going to impact things like savings accounts, maybe like HELOC rates, something known as SOFR, which really sets a lot of variable interest rates, that'll come down much quicker than the long end of the yield curve. The long end of the yield curve, I don't think you'll see much movement even as the Fed cuts rates. Big reason for that is the government still has a large deficit. We have a lot of debt. There has to be people to buy that debt. And if there's nobody to buy that debt, the interest rates will stay the same or perhaps go up. So you're going to see a bigger impact on the short end of the yield curve than the long end of the yield curve.
I have to ask you this. What does that mean in English? That was a lot of money talk of like yield curve and long yield curve. So what does that mean?
The easiest way I'm going to explain this to people is if you have, let's say, a high yield savings account, you have a money market account.
Okay.
Right now you're getting around 5% probably if you've picked a good money market account.
Okay.
As the Fed cuts interest rates, that's going to impact the short end of the curve, which is going to impact your money market. I believe next year you could see those money market rates in the 3% level. It's going to be a major shift on that. Same thing with like HELOC rates, home equity line of credit rates. Those have gone up very, very high over the last couple of years as the short end interest rates have gone up. As the Fed cuts rates, you should see HELOC rates come back down as well. So there are going to be positives as borrowing costs go down, but the negative is that interest that you're collecting on savings accounts is going to come down as well. So you've got to be careful of that and cognizant of how much money do you have in savings right now.
Okay, speaking of borrowing, I think it was like a week or two ago, we were talking about here on the morning show that the amount of credit card debt has just skyrocketed recently. So what does this mean now for people who hold credit card balances?
This is a funny one because I tell people it shouldn't matter. And the big reason is credit card debt, credit card interest rates. I mean, it's near 20%.
Yeah.
They should come down when the Fed cuts interest rates, but it might be like 18%. It is still something that you should not bank on. You should not borrow on your credit card. It's a terrible place to have debt because the interest rates are so high. And yes, if the Fed cuts rates, it should bring it down, but it's still going to be a terrible interest rate. You should not rely on that debt.
If you're looking to buy a home in the next year, and that's your plan for 24, 25, would this be a good year to do it?
You know, I think it's going to be an interesting time to buy a home. And the big thing, as I said, I don't think you're going to see a big shift in mortgage rates. I mean, we got very lucky when the 30-year fixed mortgage was under 3%. That's kind of like back in the 80s, the opposite side of that, when the mortgage rate actually topped 18%. We're never going to see, I don't think, a 3% mortgage rate again.
Wow.
I think that was just such an anomaly. But right now, the mortgage rate, it's around 6.5%. You could see it shift down into maybe the high 5s, but I don't think you're going to see anything in the 3s or 4s. So I don't think that should be a driver of whether you want to buy a home or not today versus next year. I don't think you'll see a major downshift in that 30-year fix.
Okay, one final takeaway with all of this and the changes that could happen. You would leave us with what advice?
I would say be careful of your short-term investments versus long-term investments. Again, that interest rate on your savings accounts will be coming down. If you have long-term money, long-term investments, and you're thinking, oh, that 5% is nice, be very careful because that 5% will be disappearing over the next couple of years.
There you go. That's your advice. Chase, thank you.
Thank you.
Good to see you.
Good to see you too.